So when Pulsechain launches, in my opinion, people should be watching the liquidity pools, watching the price action versus following what everybody else is doing. Bridging over something like DAI, again, could be the best play because we know there is a lot of DAI hold in a wallet currently. So one could speculate that DAI could have the most liquidity pools. So when you're thinking about having something at the fork, you don't want to do what everybody else is doing. And you don't want to be that person that makes great entry points for other people to profit off your bad decisions.
So, the expectation is that a higher hex price on Ethereum probably commands a higher hex price on Pulse. So it's also kind of that negative feedback loop. So if the price of hex dumps on Ethereum side, that also probably has a negative effect on the Pulse chain side. So just another thing to consider.
Yeah, I think one of the things to factor in is when do you want to trade, right? So you're holding something in your wallet and it's getting forked over. You get a free copy of it on Pulse chain. What do, right? Are you going to hold it for a while and let the dust settle on the after launch and all the insanity go on, and then do something once you kind of the bridge goes live and we have USD pricing for things, etc.? Or do you want to go in immediately and start ratio trading before the bridge goes live? And to me, there's different strategies for each of those situations. I think the most important thing, and I know Jesse's spoken about this many, many times, is about liquidity. You want to trade through the deepest liquidity possible to retain the best ratio possible when you want to make that trade, right? Because deeper liquidity means more stable price when you have a lot of activity going on, okay? Versus lower liquidity means high volatility. You don't want all the market movement to move against you, right? If you're not there in time. So how do you position yourself to have the most stable trade at the point in time that you want to actually execute that trade, right? And the answer is going to be different for everybody. There's still one size fits all here, but it's just thinking through what do you have in your wallet? What are you willing to hold up through the fork? And then what positions you to be able to make a good trade at the time that you're willing to start doing so on Pulse Chain. And I think that's going to help drive you to do some research and make the right decisions that are specific for your situation, right? Because you want to then understand what are the liquidity pools that are being forked over. You can look at, V2B testnet is not as great of an example anymore because those liquidity pools that got messed with by the fixer bot and a lot of things that were forked over have been abused by people on the testnet. So they're not really a good image of what would happen on day one anymore. But it's just something to think about. Look out on Ethereum mainnet right now. What's out there? What liquidity is where? Where is everyone going to go to make their trade? And what would I be able to access on Pulse Chain on day one to be able to execute that trade? And that's one way of looking at how do you position yourself when the time comes.
Is something that I extremely like, and it's a topic that I've been looking into when Pulse Chain actually launches. And it's another reason why I believe that FixerBot will be deployed from an OA, so to speak, and that is the ratios. So Pulsex is a V2, and you're talking about a bunch of tokens that are forked over that don't have a price, and there is no price discovery yet. So when you deploy a token, any ERC20 now, and say you were going to a V2, the way that you find price discovery for your token is through a ratio. So if you were the founder and you gave yourself a pre-token allocation, and say you deployed the very first initial liquidity pool, and you put up 1,000 USDC to 1,000 of your ERC20 token, you're dictating that your token's price is now $1. And then the second somebody makes the very first trade through that liquidity pool, the price discovery is made for your token. So another reason why I believe that the FixerBot could be deployed from a benevolent wallet is the fact that they would want to dictate price discovery for the newly forked over tokens. Because if they're the ones that are putting up the first initial liquidity pools, chances are that their pools are going to be the first ones that are ratio traded through, which is where price discovery is going to happen. So they have the ability to essentially choose what starting price these tokens are going to be at, whether it's at 0, whether it's at 0.0001. that comes from liquidity pools and ratio trading. And Pulsex being a V2 is the perfect home for such a thing because, again, it isn't a V3 where you get to decide the two sides. It has to be equal pairing. So for me, it's another reason why I believe it is a benevolent wallet, but it's something that when it unfolds will be very interesting to watch, where price discovery actually happens and which pools people choose to trade in and out of first. So say that benevolent wallet actually put up liquidity pools and people didn't ratio trade out of theirs first. Essentially, somebody can come through and put up a different liquidity pool. And if yours is the one that's ratio traded through first, that's where price discovery happens. So trading in Pulsex in the very first few days actually holds a lot of power with the forked over copies. And that's something for me that will be extremely interesting to watch unfold.
I saw Jake Sharp put Pulsechain fee burning is larger than 25% because EIP 1559 got merged in, and he said it's like 25% plus 25 to 75%. Is that something that we were expecting, or is that something that they just implemented?
No, that was there before, and it's kind of like they're trailing each other. So it's like a percent of a percent, and then a percent of a percent. It's not 25%, I believe. Okay. But yeah, it's just you got to think about, it's the most important thing about actually the beacon chain and everything of the merger, which people don't get. By us moving the entire merge to the new framework, it's not just a framework, think about it like a version number, like again, Unreal 4, Unreal 5. They're completely separate things. But because we're now merging off of Unreal 5, we get those perks forward as well, because it can be merged backwards since we're on the same code rubber band, if you will. But yeah, it's just like an added bonus to something, because the buyback and burn is the Pulsex. The EIP 5055 is their version of just that feature, right?
Well, I think the other challenge is we're assuming all these EIPs that have been applied to Ethereum mainnet so far are all being included in the fork, right? And in the version 3 of our testnet. The big question is really, is that the case? Will there be changes? Will there be other changes, planned above and beyond what was originally put together in V2B? It's a whole different platform. They have to go back and make additional code changes, but you also want to be able to follow Ethereum's ongoing development, including their feature scaling and improvements, et cetera. So, there's going to be a question of how far will V3 diverge from Ethereum mainnet as it is today.
No, you're exactly right. And that's why I use the Unreal example, because it's what I definitely understand, because we don't use the term forking in game dev. We call it merging. And merging, you take codelets of, let's just say, Unreal 4.8.1, right? So like maybe some of those improvements as it went up break other things in other parts of the game. So you will do a merge and take these things that you want out of that and then put it back in. But you cannot merge at all Unreal 5 into Unreal 4. It's a completely different architecture. So they had to start from scratch. But theoretically, they had their wireframes of ideas on how they wanted it to work. And now they're retooling those wireframes almost to like a different plot of land. You learned how to till your soil, grow your food, and now you're moving that to a different field. That could be a different terrain of anything. It could be a different biodome. But theoretically, you've worked out the brush strokes. Now it's retuning the paint that is on the brush strokes.
We've had so many of these conversations in these spaces where people ask, well, what do I hold for the fork? How do I do these trades on day one? Where do I go? And how do I retain as much value as possible, getting forked onto the new chain? First, the answer is nobody knows for sure, right? No one can tell, has a crystal ball and can tell you exactly where it's going to go. But we have put a lot of time and effort into debating this over the past year and a half. And having this much time has given us the luxury of being able to pick it apart and put it back together so many different ways. From my perspective is, if you want to do early trading, right, you want to trade in something that has a lot of liquidity out there. And if you look at Uniswap, you look at SushiSwap, you look at some of the, basically look at the top 10 largest decentralized exchanges running on Ethereum right now. And you look at the top trading pairs, right? They have the most liquidity across all of those. you're going to see a lot of stable coins. You're going to see wrapped Bitcoin and a couple of other things, right? You start looking through there and you say, okay, well, what do I have in my wallet? What am I willing to hold at the time of the fork? And which one of those pools might exist after the fork that I might want to trade through? And how would I go about executing that trade if for some reason this website isn't available for me to utilize? Do I know how to execute that trade through the block explorer by interacting with the contract directly? Or am I a less technical user and I need a front end, meaning I need to wait until the custom front end to Uniswap and the forked liquidity for Pulsex is already deployed, right? So it's all about trying to do some analysis and understanding how might things play out, and really, really paying attention to what is happening on V3 testnet as soon as it goes live, looking at those things and seeing how they played out immediately, giving you a really good idea of what you could possibly anticipate when the time comes. But again, ratio trading is extremely risky. You can get wrecked, ultra mega wrecked, if you don't be careful about it. That's why some people want to just wait for the dust to settle. They want to see how everything plays out, and then they'll start dipping their toes in the water, right?
So I think something that you hit on is that we've had all this time to sort of like analyze and try to figure out what might happen and all this stuff, right? A lot of that is like, it's a good thought experiment, like it's a good way to practice game theory, but I wouldn't anticipate anything. And if you're planning on doing transactions through Block Explorer, don't. Like, you should, if you really know what you're doing, you should be writing contracts that are going to get copied over, through which you could address whatever functions and methods, make whatever transactions that you want. That's if you know what you're doing. Now, I'm going to make this decision incredibly easy for you guys, because over analyzing this stuff is how people not just get wrecked, but they get left behind. You get into a bad spiral of events. Are you in or are you out? That's as simple as you should be thinking about it anytime within the first 30, 60, 90 days of Pulsechain. We will have time. When it comes to these ratios, you have to understand it. Like, if you can imagine in your mind like a Fibonacci spiral, right? So at first you see that it kind of hits those corners like relatively quickly, and then it spirals out, covers more range, and it takes longer to hit each endpoint. Well, that's what those ratios are going to do. Initially, when there's uncertainty, there's liquidity is not established, things aren't priced in, those ratios can change very quickly. Versus you see, on Ethereum examples of assets that are more priced in, they have longer price history. Those ratios don't change nearly as frequently. So just because the fact that this is new, and of course people are going to speculate and all this stuff, but what can happen is those ratios can change very quickly, much quicker than you can possibly anticipate, given the conditions of the market we've been in for the past like year and a half, almost 2 years at this point, right? So it can get a lot choppier than you expect. So what is really going to play out here is those ratios are going to change much quicker than people can anticipate and react to. You're not going to have the full functionality and features of every app every dApp that you can interact with on Ethereum now. So there's just less opportunity to do that. But you will have sophisticated players, and what they're going to do is they're going to wait. They're not going to be the first mover, maybe bridging, maybe something like that. But I don't think you're going to see people who are very sophisticated being the first ones to pounce. If there's an opportunity, something really outlandish happens, yeah, you can kind of expect maybe somebody to make moves. But you'll see that these ratios will revolve around the cohorts that are willing to trade at those points. So by you just abstaining from early ratios, whatever you're shown first, you're actually sort of helping this process along. But yeah, so what you'll see is, like, as these ratios shift, and you can kind of keep track of this, you'll see the cohort that thinks that's a good deal, right? You thinks that that's an opportunity. They'll make their move, whatever. But as it goes further along, you're going to see bigger moves being made. With a lot more information behind them. So, you can analyze this stuff like crazy. You can write your own contracts to do the things that, you want to be able to do right away. But I would make it super simple in the beginning. Are you in or are you out? And there's good reason to be out. There's also very good reason to be in. So yeah, don't do the whole paralysis by overanalysis thing.
Yeah, he hit it literally 1000% on the head, because just the bots that people will come in will spike and change the price, because if someone writes a shoddy code, that will slip the liquidity one way or the other, and another bot will be taken advantage of. So it's your first time in Disneyland, it will eat you alive, like Ether Delta did to me way back in the day, and all the rest of that stuff. So understanding those paradigms, and the smart players are the poker players that are waiting for everyone else to lay their cards out so they can move. So yeah, well said, sir.
So we will definitely see a massive amount of bot action on day one, making their moves, accumulating their tokens, and all the things that would otherwise be locked up or can be done quickly and automatically. And yeah, I agree. It's probably the best time to sit back and just watch the fireworks, right?
I'll give you guys a quick tip. I'm sorry, I know there's other hands. Really quick tip. So look at what contracts get deployed as soon as V3 goes live. Count their calls. The ones that are called more frequently, those are the ones you want to watch out for. And I'll try to kind of do some kind of insight into those. So that's what I'll be watching. Who deploys what, how often they're being called.
Well, that would be post-bridge too at that point, because at that post-bridge point, whoever the entity that holds those addresses would then bridge and bind one asset to the other, and then it would hold value in that metric sense of what came over from the other side. Sorry, I stepped on someone.
Yeah, you have to consider how these stablecoins function, right? So as I mentioned earlier, there's a redemption mechanism. So DAI is part of the Maker protocol. You can redeem it for $8 worth of ETH. When those contracts copy over, where's ETH? Doesn't exist anymore, right? The contracts themselves are searching for, to make this as simple as possible, they're searching for a ticker symbol that no longer exists, right? Pulse exists. There's also liquidation mechanisms that when those prices are not correct, accounts start getting liquidated. And where does the ETH from those liquidations go if ETH doesn't even exist anymore, right? So things start to get really complicated when you have contracts that use the native coin of the chain, and it's looking for prices of the native coin. So stable coins are interesting. Like KG, you mentioned these fork chains that happen already, ETH-POW, ETH-FAIR. When those forked over, all those contracts went with them. But because the gas coin itself was, what was it? I don't even remember, $10, $20 a piece instead of $1,600, which they were, when it was from the original chain ETH, you could literally go with, just a few $100s and get millions and millions and millions of stable coins. But then you could jump into another pair and essentially drain the pool of all the ERC20s. So the Fixer bot corrects a lot of that on the Pulse chain, but it doesn't mean that it's going to be able to fix all of it because of the way the contracts work with stablecoins.
You don't want to be that person that moves first on Pulse chain and miss out on buying lower or miss out on the best price opportunities. For many people, especially if you aren't playing with a large amount of capital, everybody has this ideology that they need to rush in and they need to buy Pulse straight away, and they need to buy Pulsex straight away, and they need to dump this and they need to do this. Sometimes just sitting still for a couple of days and watching is a better option to make. It's what big whales do. It's what sophisticated buyers do. It allows you to view, allows you to find the best entry points and then make moves versus making the wrong moves. So you'd rather miss out on a 5x and have, a speculative play not go right. You want to be able to just wait and make better informed decisions on the market. For me, I think everybody, especially if you're a smaller fish, should just sit back and watch what happens, not dive headfirst in thinking that you're going to miss out on opportunities.
And keep in mind this piece of it too. Like if you just have this idea, your hands are itchy about this whole early mover advantage type of thing. You guys, everyone who has ERC20s, you've already made your first move. So you're not starting with zero. The fact that you have those coins copied, you've already made move one. Some of you have already made two moves, if whether or not you've sacrificed for Pulse or Pulsex. So don't worry about this kind of stuff. Like if you have any ERC20s, you are already in. You already benefit from it. So don't overplay your hand.
So when you get tokens that have a free claim, sometimes their chart doesn't do necessarily what you think it's going to do. So for instance, instance, with Pulse, it has a sacrifice set of 40,000, where Pulsex has a sacrifice set of 136,000. So to speculate that the Pulse chart will do that isn't necessarily correct, but to speculate that the Pulsex chart will do that could very well be correct. So again, when you have a token that has a free claim, a lot of people do just dump it. Same with ERC20 tokens that are being forked over. You can speculate that there is going to be a certain amount of people in the market that just want to get their money and run. They don't want to hold on to a speculative asset to see whether it's going to play out in the form that they want it to. So sometimes just holding back and waiting for those opportunities is the better play. Again, Pulse does have a lot lower sacrifice set to everything else, so it may necessarily not have that type of price performance as other things. But so if you want to look at speculative instruments and new things, Pulsechain is new. You haven't really seen forked over things before. Yeah, we've seen it with ETH Proof of Work, but it was completely and utterly different. There wasn't a bridge to start and there wasn't a native deck. People opened up front ends and deployed relayers to pull liquidity from other dexes. It didn't start off the same. Didn't have a fixer bot that harvested the liquidity to bring it back to a deck. So Pulsechain is something that hasn't been seen before, but compare certain tokens to certain tokens that we already know and their price performance. So again, being a spectator and a sophisticated buyer could play out to be a better play in this scenario.
So Pulsex raised almost $1 billion, you guys. That's more money than FTX got in Series B funding. Together with Pulse and Pulsex, it's as much money as Telegram got in funding. So I know we're trying to look at it through this lens of what we saw before, but it's different this time. And I think Pulsechain is going to surprise a lot of people in a very big way. So just keep those numbers in mind, and we know where that capital is going to flow. So, we haven't seen this before.